All right, welcome back to Module 10 of the Speed Banking class. In this module, we're going to be talking about the tax implications, but before we dive too far in, I've got to share my disclosure. I am not a licensed attorney, or in this case, very important because this module talks about taxes, I am not an accountant. I'm not a financial advisor, broker, agent, or any other licensed individual. I've just picked up a lot of information and I want to share it with you. And it's important to understand that I am not going to discuss or provide any specific counsel, advice, or instruction in this module that would apply to specific individuals. This is just intended to be general information, so please take it as such. It's just for educational purposes. Let's go ahead and dive in. Okay, the biggest question that I get is I get a tax deduction for my mortgage interest. What happens to that if I start using the speed banking strategy? And the answer is it goes away. Now, that doesn't necessarily mean that you don't want to do speed banking strategy, and I'll show you why. Do the math, right? That if you've learned anything from this class, it's do the math. Don't just assume that your tax deduction is better. You're going to get a better result by taking your mortgage tax deduction than if you go out and do speed banking, because in most cases, almost every case that I've seen, that is not true. And here's a good example of why that is or is not true. So running the math here, our speed banking numbers. So if your income is $50,000 on both sides, we've got the speed banking column here, the traditional example here. Your mortgage interest is a total on the traditional side is a total of $10,566, especially if you're doing the flip method and going and getting a first position HELOC. You don't have a mortgage, so you don't have any mortgage interest. They're not going to count the HELOC interest as mortgage interest, so that answer is zero. Your taxable income then becomes, here's the difference in your taxable income based on that mortgage interest deduction. So with the speed banking example, you would remain at $50,000, but in the traditional example, your adjusted gross income would go to $39,434. So that means that your taxes paid are going to be a little bit higher on the speed banking side, $12,500 versus about $9,800 on the traditional example side. So your difference in taxes, the benefit, if you're only looking at the taxes, the benefit is in the traditional example, because you're paying $2,900, almost $3,000 more in taxes on the speed banking side. So that's why I think most people look at this and like, oh, I don't want to do speed banking because I'm going to have to pay $3,000 more in taxes, right? But your disposable income, your total disposable income is $39,500 versus $29,575.50 because of speed banking, right? So taking into account those factors, so you've got a $10,000 advantage here when it comes to speed banking over the traditional example, even though you're paying $3,000 more in taxes. And that comes from the idea of you're not paying as much in interest, you're not paying as much in non-recoupable principal. And I'm talking about when you make that mortgage payment, 100% of it disappears. You can't reuse any of it, right? Well, we're only reusing the taxable, we're only losing the interest portion of the speed banking. The principal that we're spending is totally reusable, and that's where these numbers come from. So you've got a $10,000 advantage. That $10,000 sits on top of your line of credit, lowering your debt by $10,000, thereby charging you less in interest. So in my opinion, the advantage is with speed banking in this case, and here's why. However, I will say this, with all tax implications, and the reason this module is so short is because I am not your accountant, and taxes are very, very subjective. So as you're going through this, you may have to educate your accountant a little bit on what it is you're planning to do. Make sure that you take the time to prepare for that. Go through this class a couple of times. Make sure that you understand it well enough that you can explain it to somebody. And that's actually a good thing, because teaching something, you learn more than if you're the student of something. So practicing explaining this to your attorney, to your accountant, is going to be a good thing. There are going to be other tax deductions that you're going to be able to take because of speed banking. There are going to be other implications that are going to happen in your personal situation because of speed banking. You need to work closely and directly with your accountant. If you don't have one, get one, because if you're going to go out and do real estate investing, so important that you have an accountant. Watch our tax basics class. It's so important that you have an accountant if you're going to go out and do real estate investing and start operating like a wealthy person. Wealthy people don't do their own taxes, period. So if you back to the mindset class, if you're going to be a wealthy person, act like one. Get an accountant. Let the professional do his job. Aces in their places. Make sure that you review with them your entire situation and understand the effects that speed banking is going to have on your tax situation, including but not limited to your mortgage interest deduction. Okay, and go through, make sure you're doing the math. They're going to tell you, if you're looking, and also remember what they tell you. You have to take that and plug that back into your speed banking model, because they're going to tell you what the tax implications are. But as we saw with the mortgage interest, it's still better to do speed banking because of the cash flow advantage that creates and the debt payoff advantage that creates versus the traditional way. Even the accountant will say, hey, you're saving $3,000 in taxes this way. So make sure you take their advice, go back and plug it into the model, and do the math. That is the most important part of this whole strategy, is doing the math so you understand. Carry it all the way through to the end. Carry the numbers all the way through the end so that you understand what's going to be the best advantage for you. So that wraps up Module 10, tax implications. In the next module, we're going to be talking about emergency funds. So I will see you guys in Module 11.